Welcome, Andrew. I'll just give a quick introduction and we can get started. Good evening, everyone, and thank you for joining. I'm Rakhi Jain, founder and CEO of Culphrix Global. I'm a chartered accountant, chartered wealth manager with over 23 years plus of experience in strategy, corporate finance, business performance, primarily with Unilever across India and Middle East. Through Culphrix Global, what I'm trying to do is I'm on a mission to empower 100 plus families on their path to financial freedom. I'm also very passionate about investor education and learning, and this session is really a step in that direction. It's really my pleasure and privilege to welcome Mr. Andrew Holland, who's the head of new asset class at Nippon Management. Andrew brings with him more than 4 decades of rich global experience spanning UK, Asia, Japan, and of course India. And the Indian markets he understands very well. Over the years, he has held leadership positions across some of the world's most respected institutions, including Barclays, Credit Suisse, DSP Merrill Lynch, Ambit, and Aventis. He has consistently been recognized as a top-tier analyst and strategist, and anyone who has been following his work will really understand why. Most recently, he led Aventis Capital Alternate Strategies as CEO, where he helped shape one of India's most successful alternative platforms. Before that, he was CEO at Ambit, where he played a pivotal role in building one of India's largest hedge fund. So that's a short introduction about Andrew, and also at Nippon, where Andrew currently heads new asset classes. He's recently launched the Nippon Long Short Fund in GIFT City, specifically for NRIs and foreign nationals. And I think in India, for Indian residents, a specialized investment fund offering is in the works to be launched soon. So today with Andrew, we'll break down what long short strategies means for investors, why GIFT City, and how these products can really open up new avenues for diversification for our investors. So Andrew, it's really a privilege to have you with us today.
Thank you, Rakhi. It's a pleasure, and thank you so much for the opportunity.
Thank you, Andrew. So let us dive in straight away. Could you explain to our investors in really simple terms how a long short fund actually works? How is it different from a regular mutual fund or a regular fund? And what kind of investors it is suited for?
See, hedge funds globally is really around between 15 to 20% in terms of alternative investments, in terms of clients or customers' overall portfolio. Because everyone will have their individual mutual funds on the long only side, whether it's equity or debt, and they'll also have their own kind of portfolio of stocks as well. That's really a long only kind of part to your portfolio. So what investors like to see is other products which take you along the risk curve, but also help protect your downside to some extent and look at risk adjusted returns rather than just pure returns from markets. So that's really the background to how kind of hedge funds or alternative investments came about. It's really a kind of an extra avenue for investors to invest in markets, but with less volatility. If you take today's markets or since the beginning of the year for India, it's been very volatile, and obviously markets have fallen. So when you come into with investing in these funds that we'll talk about, you're looking at the risk adjusted return. So you're hoping that you'll protect the downside in these more volatile markets, but participate when the markets start to move ahead again.
Andrew, you mentioned that these funds actually help to manage risk better. How should investors think about risk management in such strategies, especially compared to, say, a traditional equity or a debt fund? How does risk management actually work in these kind of strategies?
So what we do is see the GIFT City fund that we've launched is what we would term as a long biased, long short. So you'd have 60 to 80% of the money is invested in core holdings, your core blue chips, large cap stocks, and those would form the basis of obviously the returns going forward. And then what you're doing is saying, if markets fall, then that core portfolio might fall as well, right? In line with the markets, as any long only fund would. But what it gives us the ability to do is to protect those stocks, maybe by hedging those stocks or doing tactical trades as well, which will enhance the returns going forward. So what you're trying to do is say, if you're a long only fund, for example, and the market falls by say 5%, Like by a large only, long only mutual fund will probably fall around the same amount, a little less for some of them, a little more for some of them as well. So what we're trying to do is say that we want to protect that portfolio by using derivatives and hedging some of those stocks, whilst also, if we feel the market's falling, to take other short positions as well, maybe the index, maybe individual stocks, which will protect you on the downside. So the key is when the market falls by, say, 5%, you're looking to not fall by as much. So hopefully anywhere between half of that is where you're looking to protect. So if the market falls by 5%, you've only fallen by 2.5. And then when the markets start to move up, you can participate back again on the long side of the portfolio. And so you're getting alpha on the downside and you're getting alpha on the upside. I hope that explains.
So that does. So basically, you're saying the returns would be in line with equity with half the volatility of a typical equity fund, or maybe even half.
Exactly that. If you think about it, if you fall 5-10% in the market to get back to break even, it takes a lot more percentage wise on the upside. But if you only fall by half of that, then the move back to where you were previously on your NAV is a lot quicker. And of course, the one advantage of this fund, Raki, is that we can use leverage up to 1.8 times. So here's the scenario. So market falls by 5%, we only fall by, say, 2.5 in this instance. Then when we feel the markets are going to move higher again, a long only fund would have 100% invested. We can make our long only part nearer to 130, 140 long. So again, participate more on the upside. So you protect the downside and you enhance the upside by participating more through leverage.
Got it. Got it. So, Andrew, could you walk our investors through a couple of illustrative examples, perhaps any past trades or any kind of example scenarios that you want to talk about that show practically how these strategies work?
Yeah, for example, let's say you're holding quite a large portion of your long only portfolio in banking sector, which you would have to do because it's a large weightage anyway in the index. Now, if for any reason you would feel that maybe banking stocks or the interest rates are going higher, whatever it might be, which would bring the banking sector down, you have a few things you can do. You can hedge your existing holdings, your core holdings, so you don't participate in that fall. And also say, okay, we think the banking stocks are going to fall, so therefore we could actually kind of add an extra tactical short on the bank Nifty index or individual bank stocks. So you're protecting your portfolio, your kind of financial stocks, but also trying to make some extra gains from the fact that you're seeing the market fall and particularly the banking index. More kind of recent trends that we've seen, obviously, in the markets is a weaker rupee. And so therefore, how would you play that? We could look to say the IT stocks should be the likes of Infosys and TCS should benefit from a weaker rupee in terms of their earnings. Therefore, you could be long that stock and maybe think of, say, airlines as being an area where they might see a slowdown in people traveling overseas because obviously the costs of is going to be higher because of the weaker rupee in terms of buying tickets. So that would be a trade which you could do. When GST was announced, we looked at saying, okay, who would be the bigger beneficiaries? And we felt it would be more the domestic two-wheeler stocks. Aisha would be a good one there. And maybe would say that Bajaj Auto, which isn't really participating in terms of a lot of its exports for them, so they wouldn't get a bigger rise in buying because of that GST reduction would also mean that that stock might underperform. So that would be a natural buy Aisha short to Bajaj Auto. You could have easily done that with Tata Motors because obviously Jaguar is not going to benefit from a GST cut here because most of its sales are to China and overseas and they have their own problems. So again, that would be a nice short to have against your more locally exposed auto companies, which would benefit more from the GST cut than the ones I've mentioned.
Got it. No, this is really interesting because, like you rightly mentioned, every event, whether it is depreciation of the rupee or GST, typically has some sectors or some companies which would benefit and some companies which would not benefit. And this fund actually gives you the opportunity to have a say in how, play both these benefits, the companies which are benefiting and the companies which are not benefiting. But Andrew, like markets are not as simple as that. Sometimes what we expect does not happen. And in that case, how do you then manage the risk around it? Because leverage obviously also leads to higher risk
Um,
from that perspective. Yeah.
Yes, it doesn't necessarily lead to higher risk because you have your core portfolio and all you're doing is saying that yes, the markets are going to go higher, for example. But when you're doing that, you're not just everything's going to be long, right? You're not going to be fully long. You're going to have hedges to protect you. So, for example, if you were fully invested, even using with leverage, we would take out some out of the money put options, which would protect you for a rainy day. They would be quite a large portion of the portfolio in terms of mitigating that risk. So
Mm.
there's many different ways to think about hedging, but what you're doing on a day-to-day basis, Raki, is you're looking at the risks that you're seeing both globally and locally, right? And so if we're looking today, what are we seeing? It's worrying that there's no trade deal for India. So what would we think about that? And how would we play? Obviously, you could say that the rupee might continue to be under a bit of pressure, and therefore you could continue to see outflows from foreign investors, which will probably be towards large cap stocks. So that means that the Nifty would have, or the Nifty index would be under pressure, which we've seen, right? So you can say, okay, I'm long these stocks, but I think the index is going to fall. Therefore, I will take out some options, or I could even short the Nifty through futures to protect the portfolio. So it's really on a day-to-day basis. You're looking at the risk and saying, do I need to increase my hedges because I see more risk, or reduce them because I think now we can see that the markets are going to move higher, and therefore you don't want to have so much kind of protection, although you'll have some there just for that expectation of a rainy day.
Got it. Got it. So it's interesting that we are actually using hedging strategies to reduce the risk and actively manage it. And this is actually a concept, Andrew, which is quite popular globally. And you're, of course, an expert in this both globally and India. So, what lessons are you taking from these successful global hedge managers? And how do you think Indian investors can learn from this and benefit from these strategies?
So I think investors already have started to utilize these products successfully in India. There's been many local funds, and I was one of the first to launch a hedge fund in India, and it really fit into everyone's portfolio quite nicely because, like today, if you think I want to buy the Indian market, but I'm worried about some of the geopolitical risks, what's happening in the US, but I don't want to miss out, right? Because that's always the worry, then these kind of products give you the opportunity to participate in the market, but protect you from more significant falls that the market might have in the shorter term. So it makes you a little bit easier in terms of sleeping at night, knowing that you're being protected at some point with your portfolio. So just think about your own portfolio, and if you could protect it, how would you protect it in these kind of volatile markets? And that's what our job is to do. So reduce. So if you had to position this, Raki, I would say it's more of equity minus in terms of risk and equity plus in terms of returns. That's what you're looking to do.
Okay. So, risk and volatility lower than equity, but returns would be higher than equity.
Yes, if you take the benchmark as Nifty, then that's what you're aiming to do. Protect your downside. So equity in terms of risk is lower, but in terms of returns would be higher because, as I say, if you protect your portfolio on the downside and you can participate when the markets move ahead again, with given the fact that you can use some leverage, means that you can get those extra returns.
Got it. Got it. Andrew, you spoke about portfolio construction and asset allocation. So coming to this particular fund, which is the Nippon Long Short Fund, what do you see the role that this fund can have in a portfolio construction of, say, a HNI or a family office which is looking in? What is the role? Because there are so many categories of funds available. There is large cap, mid cap, small cap, and debt, equity. So how does this fund fit in within that portfolio?
So this is mainly towards the fund will invest mainly towards large cap stocks. So it's really going to be the benchmark we benchmark ourselves against is Nifty, the Nifty 50. So it'd be more large cap in terms of that. It doesn't replace your own holdings. So I'm sure everyone, the high net worth individuals, would be owning mutual funds or whatever stocks they have, whether it's large or small or mid cap. This is a this is to say that I still want to invest in the markets, but I feel that there's some risk globally or whatever it might be. And therefore, I want a fund which will manage those risks for me. So I'll participate throughout and reduce my volatility as I put more monies towards India as a longer term view. So it doesn't replace it. It's an addition to what you have when you want to increase your exposure to Indian equities.
Got it. Got it. Thank you. I can see there are some questions from the audience. I'll just take a minute to answer those. As an audience, I'm not able to see the option of audio and video. Just a quick thing that we want this to be an interactive session. So if you have any questions, answers, or comments for Andrew, you can just put it either in the Q&A box or you can raise your hand. And if you raise your hand, then I'll allow you to kind of speak and open up your video. So then you can speak and ask the question yourself. So please either put your question in the chat in the Q&A section or raise your hand so I can invite you to ask the question. Andrew, there is one question in fact right now which asks, how does hedge cost impact the return of the fund?
Yeah, so if you take you're fully invested and you then would say that you'll take out of the money options to cover some of that risk of something untoward happening outside of your kind of thinking, then it will cost you at least 1% a year in terms of the cost. But we think that's it's a price worth paying because you don't know when things will turn. We can see that all the comments by Donald Trump these days, one of them might be a bit more scary than they are at the moment. And that's where markets globally would maybe fall quite sharply. So you're just protecting for that. But at the end of the day, this fund is still aiming to outperform Nifty by 200 to 300 basis points over the course of the next 2 to 3 years.
Yeah. And the outperformance is basically after all costs and fees. So Andrew, if you can also talk a little bit more about Gift City, because there's the alternate asset classes in India are really evolving. And within that context, Gift City is actually coming up as a platform for a lot of these innovative strategies being launched. Your thoughts on Gift City and how do you see this whole space evolving?
No, Gift City has been a huge success story so far. Initially, it was utilized by funds and distributors for having Indian money go into foreign assets in terms of whether it's the Nasdaq or whether it might be as a diversification of Indian money into outside of India in terms of markets. But increasingly now, with valuations that more compelling in India, and expectations that India is going to be a long-term growth story. I won't go through it. I'm sure everyone knows it, the story, that people want to participate. And therefore, you're seeing either funder funds or feeder funds coming into which will come into our own mutual fund industry here. And that's increasingly what we're seeing within Nippon with our funds and obviously across the board. I think now is a ripe time, given the volatilities that we all know about in terms of global geopolitical problems. Launching a hedge fund like this gives investors outside of India the opportunity to invest in India with their downside protected, and also the advantage of Gift City from our perspective for the fund is that the derivatives that we'll use, which will be futures and options, are not taxed. So it's a very tax efficient way of coming into India through this fund and not being taxed at all virtually.
Yeah. Yeah, that's the first, I think, not being taxed in India for profits earned in India.
It's a great move by Gift City, and I think we'll find a lot more funds like this going forward. And I think if we can help increase the awareness of these kind of funds, that would be great too.
Yeah. I think there are quite a few resident Indians also who would like to get exposure to this kind of strategy. So what are the options for resident Indians? I believe there is a SIF that you're planning soon. So if you can give us overview of that as well, Andrew, that would help.
Yeah, just a bit of history on this is that resident Indians can participate in these strategies through Cat 3 funds in India. A Cat 3 fund is classified as a hedge fund, but the taxation on these funds is nearer to 40%. So it really has been a bit of a dampener. Now, what SEBI have done is introduced a new class under mutual funds, which are the specialized investment funds, where similar strategies can be deployed without any kind of leverage. The taxation would be mutual fund taxation. So there's obviously a big gap now between the taxation of a mutual fund and an AIF Cat 3. So I think you'll find a lot more investors utilizing this vehicle. One, because again, all the attributes I've just given to you about protecting on the downside and participating on the upside, I think they will start to use this vehicle, not necessarily again as a move away from the long-term views of mutual funds, but as an add-on to maybe ride the volatility a lot better over the next 1 year. And I think that's how we're going to see this industry grow very quickly. So we will be introducing these types of products in India for resident Indians too.
Got it. Got it. So tax does play a big factor because it ends up being the highest cost that you bear, and 40% versus 12.5% is a reasonable difference.
Just an aside, when we first launched one of these funds in 2013 in Cat 3, we used to spend 15 to 20 minutes talking about the strategy and the balance of the hour talking about taxation, because everyone was just upset that it was such high taxation, because our track record previously was getting consistent returns of around that. I'm talking about the absolute return fund now, of around 12 to 14%. But after time, it takes you back down to 7. So you were nifty-like returns, but debt-like returns at the end of it.
Yeah. So true. So this is actually then a good move by SEBI, which actually with the minimum ticket size also much lower at 15 lakhs versus 1 CR and Cat 3 funds. This is an opportunity for a lot more investors to participate in a tax efficient manner.
Actually, Raki, it's 10 lakhs, and what SEBI did as well. So if you launch, there's about 7 funds you can launch, but let's just say you launch 3 funds. Nippon was to launch 3 funds. Then that 10 lakhs can be invested between those 3 funds. So it's not 10 lakhs per fund. As long as you come to the same mutual fund house, then you can split your risk between 2 or 3 funds as well if they were on offer.
Got it. Actually, that's a question now by another investor, Dipesh. How can we invest in such specialized hedge funds as resident of India?
But the specialized investment funds you can invest, and there are other competitors do have launched their funds recently. You could look at those. So that's one way of doing it.
It's, I think, very similar to a mutual fund, Dipesh, if I can just add to what Andrew is speaking about. It's very similar to investing in a mutual fund where you open a folio and then invest with a minimum ticket size of 10 lakhs, of course, in total with the AMC. There's one more question from Tanmay. Which are the hedge funds in India? Which I think partly you covered, but if you can elaborate more, and how would the strategy be different from buying an option? Just buying a vanilla option to hedge the portfolio, how would this strategy be different?
See, you can do that. You can buy options against your holdings if you had a blue chip portfolio. As the question was before, there is a cost against that. So you're not necessarily using options all the time to protect you. You're using individual stocks or indices to protect you on the downside and make tactical trades to enhance the returns that you can make from your call, whether you think the market's going up or going down. So I think that's a big difference. You're managing risk on a day-to-day basis. You're not saying, I'll take an option out just in case, because you could be doing that and the markets could continue to rise, and therefore you're just losing out on your returns. Whereas with a hedge fund, you're not necessarily doing all of that all of the time. You're actually taking advantage of market conditions, different sectors, different companies in terms of their kind of momentum, their earnings growth, and being able to participate in the markets with leverage, which you probably wouldn't be able to do in just by using options to protect your portfolio.
Absolutely. Okay, I don't see any more questions. And Andrew, since we have you on the call, maybe one final question from my side. What is your view on the current markets in India? How do you see this year progressing for the markets? And what is your general macro view on the Indian markets?
I think GDP will be around that 6.5 to 7% growth. So I don't think that's gonna go down so much from here. I think everyone says the question I keep getting asked is when foreign investors come back to India? And it's a good question. So there's two parts to it. One, sorry, that's the one question. The other question is, what about the rupee? Now, I think the two are interlinked. So let me try and explain that. One is the rupee falling was not necessarily just because of the lack of a trade deal with the US or the sanctions that were put on to the US, to India. It was more to do with the balance of payments being negative. And that's partly because, as we've seen with all these IPOs, you've seen a lot of money taken off the table by private equity companies, and they've not reinvested because they're taking advantage of the markets or the valuations that they're getting for some of these companies, but themselves saying we're not finding value elsewhere. So your kind of foreign direct investment, including private equity, has fallen from like 60 billion to about 7. And then foreign investors, seeing that the rupee was depreciating, obviously took money off the table. But those more exciting markets outside of India, like China, Taiwan, Korea, which is all a big play on AI, which India doesn't have, right? Whichever way we look at it, we're not a big player in AI at the moment. So all the monies went into these markets. So how would that reverse? We think that the rupee will stabilize now, and could see with the trade deal, obviously the rupee then strengthening a little bit more if that was to, as and when that happens, and that will bring foreign flows back if and when some of the narrative around AI, I'm not saying it's a bubble, but in terms of some of the worries forcing some of these stocks to fall, you'll start to see monies come back to places like India very quickly. So if you go back, say, a year and a half ago, what was it? No one liked China, and India there's no China plus one, it's just India now, and how that reversed very quickly. And I think that will be the same here. And when foreign investors come back, they're going to start off by buying large cap stocks and then gradually move towards mid and small. So I think, my earnings growth for this year, 26, 27, that is around that 10 to 12%, right? And I think the market should move up in line with that, would be my view. So there's another 10 to 12% from here by the end of the year. So that I don't think is a bad move. But if some of the positive things I've mentioned happen, then you could see that acceleration of the index a lot quicker than my 10 to 12%, because everyone will buy large caps at the beginning.
Makes sense. There's one more question with regard to metals. I think it's basically talking about gold, silver mostly, which have basically been the hero performers of 2025, and how do you see them playing out for this year?
I'm not a gold expert, and I think when I was walking around with Samantha, a lot of people said, "What do you think about gold and silver?" I do own silver, and at that time, I think the price was about 60. I'm talking about the US dollar price of silver, not the mutual fund price. So it's about 60, and I said that I thought it would probably go to 90. So still a little bit way to go yet. So I'm a holder of silver.
Got it. I think I don't see any more questions. So thank you so much, Andrew, for sharing such clear and very practical insights. sure today's discussion has really helped many of us, at least me, understand long short strategies in much more detail and how we can use this as a diversification and risk management play within our portfolios. So thank you so much. It was a real pleasure speaking to you.
It's my pleasure, Rakhi, and thank you again for the opportunity. And if any of the people who have logged in have further questions, more than happy through you to help answer them.
So, Andrew, so much, and thank you, Simant, as well.
Most
And to everyone who joined, thank you for your thoughts, and hope this session really added clarity on how you think about long, short, and hedge funds in your portfolio. And yeah, I think there were some questions on Nippon funds and so on, which we can discuss one-on-one. So I'll reach out to you. And also feel free to reach out to me directly if you would like to understand more about any of these funds. And wishing you all a wonderful evening and look forward to seeing you at our next session.
Thank you.
Thank you.
Thanks.
Thank you.
Have a great evening ahead. Bye-bye.